Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, what I want to do was talk about probably the most commonly asked question that I've gotten over the last 24 months as we found ourselves in somewhat of an elevated interest rate environment, and that is, how exactly do interest rate affect commercial property values? So in today's video, we're going to explain just that, and we're also going to go over a graphic that I think does a phenomenal job of providing a visual representation of exactly how interest rates can affect commercial property values over the long haul. Now, before I dive in this video, I would greatly appreciate it if you can like and subscribe to this channel. It really does make a difference in the YouTube algorithm and ensures more and more people can hear this message and learn about the many facets of commercial real estate. So now you've done that, go ahead and like and subscribe below. Let's go ahead and dive right into this episode. All right. So the question is, how do interest rates affect commercial property values? Now, in order for you to understand how interest rates do that, you have to first understand the different valuation methods of commercial property. Now, typically when an appraiser values a commercial property, they will look at three different valuation methods. The first is a sales comparable approach, which is similar to residential real estate, where they'll look at a lot of different commercial properties, kind of compare them to the subject property, and then draw a conclusion based on the value, based on what the price per square foot of those different properties are. That is the valuation method that commercial appraisers assign the heaviest weight to when it comes to owner-user property, meaning that you are going to be occupying the space for your business. Now, there's a cost approach as well, which is the second valuation method. This valuation method is one that appraisers assign the most weight to when it's a new construction, new development, and there's not really a good comparison to that particular product. So, for example, if you're building a brand new apartment building, oftentimes you're not going to have a lot of comps related to that exact type of new build. So the cost approach comes into play, meaning that what does it cost to create that new structure? So that is a method that is usually assigned the highest weight with new development. Now, the third approach, which is what drives a lot of the commercial property market, because again, commercial real estate oftentimes is bought as an investment. So there is a valuation method called the investment approach, or the income approach, I should say, and that's based on the income produced by the asset, and then you would assign a cap rate or capitalization rate to that income that's being produced, and that would draw a eventual value based on the income that is being produced by that property. So we're going to focus on that valuation method because, again, as I said before, with commercial real estate, especially if you buy it as an investment, that's the valuation method that appraisers are going to put the heaviest weight on. So with that preface to my discussion, let's go ahead and share this graphic, which huge shout out to my buddy Chad Griffiths, who actually created this. It does a really phenomenal job of providing a visual representation of what exactly happens when you modify interest rates and how that essentially affects the broader market as a whole. So when you go to finance commercial property, and again, most of commercial transactions in the marketplace are debt driven, meaning that people take out loans to be able to purchase these properties. Lenders will look at, among other things, your debt service coverage ratio. So what exactly does debt service coverage ratio mean? It means that it is a equation that analyzes the income produced by the property divided by the debt to be serviced. So let's think that let's take an example of maybe your NOI, your net operating income, after you take your gross revenue, subtract out of your operating expenses, and you're left with your net operating income, right? So if your NOI is $5,000 a month and your debt to be serviced, meaning that your monthly payment to be able to service the debt is $4,000 a month, you take 5,000 divided by 4,000, that gives you your 1.2 debt service, right? So that'll be, or 1.25, I should say, debt service, which is what this means right here. So oftentimes lenders will look at your debt service to ensure, okay, are they able to comfortably pay the mortgage over a period of time? If this debt service drops too low, let's say 1-to-1, that means that any fluctuations or disruption in the operations of that property could cause you to miss payments. And again, lenders are risk averse, so they want to make sure that you have a comfortable cushion above that amount to make sure that you're able to service your debt properly. So oftentimes, lenders will say, we want at least a 1.25 debt service to be able to issue the loan for you. So what happens in this environment? Well, in a low interest rate environment where, let's say, we were 4% back in 2021, if you wanted to take out a loan, LTV, or a loan that was essentially 80% debt, and then you come to the table with 20% equity, the cap rate that you'd have to buy it at would be 7.3. Well, 7.3 in many environments across the country, especially here, is achievable, right? There's plenty of properties out there that you can debt service at 4% interest rate that were a 7.3 cap rate, especially in the middle of the country. So in other markets across the country, like a California or New York and everything else, that's why you were seeing very low cap rates. In this case, let's say that you come to the table with 40%, you could get as low as a 5.5% cap rate and still meet your 1.25 debt service coverage. And in those environments too, lenders may have given a little bit on the debt service coverage. They said, okay, well, you know what? Maybe we only need 1.2 debt service coverage ratio, because again, they were trying to loan out money as quickly as they could, and therefore they were able to, get these deals done in a lot more readily. Now, as you start going up the ladder on the interest rates that are being charged by banks, look what happens. In order for you to get the same loan at 80%, meaning that you come to the table with 20% equity and the debt that you incur is 80% of the total purchase price, now you have to be at a 10% cap rate in order for the bank to feel comfortable to issue the loan. Well, that's much harder to come by as far as an opportunity is concerned, because usually, in most environments, a higher cap rates means higher risk. In the case of, in this case, it just means that there's going to be a lot less opportunity for you to be able to buy these properties, because again, sellers aren't willing to go to that length to be able to sell their building unless they're in some sort of distress. So, and the same goes for here. So for example, even if you come to the table with 40% of the equity in this environment and an 8% interest rate, you're still going to only be able to fund the loan if the opportunity is a 7.5 cap, which is, again, in many parts around the country, is not achievable. So what happens? You achieve stagnation. There's a lot of friction in transactions because lenders don't want to issue the note, and they're going to be requiring even more equity to come to the table. So let's say that you find a 6.5 cap deal. In this environment, you're going to have to come to the table with probably close to 50% equity, meaning that if you buy a $2 million deal, you have to come to the table with $1 million to be able to get that deal done. There's a lot of investors out there that don't want to put their money to work at that leverage, because they're not going to achieve the same level of return they would at a lower leverage, or higher leverage, I should say. So you experience a period of stagnation of transactions. And so what we're likely going to see over the next, call it, several years, is we're going to see there's going to be parties that they're going to have to give and take, right? Because right now buyers are on the sideline, especially on the investment side, and they're just waiting to see what happens with sellers. And at some point, sellers are going to have to determine that if they really want to be able to sell their property, they need to be able to come to the conclusion that they need to increase the cap rate of that investment, meaning the price of that asset is going to have to come down. In an environment where, we also receive some relief as far as interest rates is concerned, now you start seeing, two parties that are very far apart start to become in equilibrium. So I envision over the next, call it, year or two, most likely closer to the 2-year mark, we'll start seeing somewhat of an equilibrium in buyers and sellers coming to an agreement on what the new price landscape will look like. And this, like I said, this graphic is phenomenal to be able to play around with. You can, like I said, you can even go in here and put, 1.3. Let's say that you got a lender that would give you a 25-year amortization, and it will affect the total, cap rates that you could achieve based on the different interest rates that are being offered. I'm happy to link this in the description as well, so you guys can reference it. But hopefully you guys gained some value from this video. Hopefully this explains why you're not seeing a whole lot of investment transactions going on right now. To my point, the main investment transactions that I've done this year have been heavy down payment or all cash, because those are the deals that are able to get to the finish line in this current environment. Hopefully that does change over the next, call it, year and a half, because I think that at some point you're going to have sellers and buyers realizing that in order for us to get a deal done, there are going to have to be some compromising, but it's also going to what's going to happen in the broader market as far as interest rates. That's also going to affect how quickly that does transpire. So hopefully you gain some value from this video. If you like this channel, please like and subscribe. It does make a difference in our ability to reach a broader audience, and we would greatly appreciate the support. Along with that, if you guys are looking to buy commercial real estate in the Louisville metro area, I'm a commercial real estate agent in town. I'd be happy to help you with your search. Feel free to reach out to me at 502-536-7315, or you can reach me via email at raphael@crosantigroup.com. Thanks again so much for tuning in, and we'll see you all next time.